Rates are going down. That's right, you can expect lower rates in 2024. These are the headlines that we're seeing everywhere today. And that's because Jerome Powell came out and said in December that the Fed was going to lower rates at least 3 times in 2024. And the markets went crazy. But is it really going to happen? So in this video, I want to talk about why waiting for mortgage rates to come down may not be the best plan, because they might not come down. All right, so first let's start with the difference between the Fed fund rate and mortgage rates. The Fed fund rate is the overnight lending rate. It's what the Federal Reserve does to either stimulate the economy or slow it down. During COVID, people weren't even allowed to work. The whole world came to a complete stop. There was no pollution for a moment because people weren't driving their cars. So pandemics are recessionary. And in order to avoid a full-fledged recession, the Federal Reserve lowered rates. And they lowered rates to stimulate the economy because when money's cheap, people spend money. And our economy is based on people spending money. In fact, 70% of our GDP is based on us just buying things, spending money. And that's what the Fed does, tries to make it easier for us to buy things by lowering rates. Now, they do the opposite. When the economy gets too hot, they start to raise rates because they don't want to create inflation. Well, we know this. We saw rates too low for too long. There were too many buyers trying to buy things that there just wasn't enough of, because remember, we were in a pandemic and everything was shut down and people couldn't produce things, yet money was cheap and people wanted to buy the things that there wasn't enough of. So that created inflation. So the Fed came to the party a little late and started raising rates to slow down that inflation. This is old news. I'm sure you know it, but I just want to explain the difference between the Fed fund rate and mortgage rates. So as we saw starting in 2022, the Fed started aggressively raising rates to make money more expensive. And again, this is the overnight lending rate. It's the rate that banks pay to borrow from each other. And it very much affects credit cards, car loans, and adjustable rate mortgages. Now, on the other hand, the mortgage rate isn't so directly tied to the Fed fund rate, but it is indirectly. It's bond investors who can make mortgage rates go up or down. When a whole lot of investors are buying bonds, well, the yield goes down, rates go down. But if the investors leave and they don't buy bonds, then the yield goes up because they're trying to attract those buyers, having to give a higher rate to be able to sell the bonds. Now, why would investors either buy or not buy bonds? Well, generally speaking, a bond is kind of a safe bet. It's kind of a low return, and it's what investors buy when they need safety, when they're nervous that the economy is going into recession and they just want to buy a government bond because it's kind of a sure thing. But if the economy is booming, investors can make a lot more money in other investments like the stock market or in real estate. So that's where they put their money, in a booming market. So the Fed kind of gives investors a clue as to where the economy is headed. When the Fed announces that there's going to be rate cuts, well, that has investors thinking, maybe there's a recession coming. Why would they cut rates? That means that something bad might be happening. So I better buy some bonds for safety. But when the Fed says that they're going to raise rates or hold them, well, that kind of means that maybe the economy is really strong and booming, and maybe we should put our money into the stock market or something that's going to give us a higher return than the low return of bonds. So it's been very confusing over the last few years because the Fed has been raising rates to slow down the economy, but every single month we haven't seen a slower economy. This doesn't normally happen. Normally when the Fed raises rates so quickly, it's like taking a fast car and slamming on the brakes. But we just didn't experience that in the US. Instead, almost 2 years after the Fed started raising rates, we still have enormous job growth. We have very low jobless claims. We have a low unemployment rate. These are all things that are not recessionary. So both the Fed and investors are kind of confused as to where to put their money. Is the economy booming and should they be investing in stocks? They have been. Or are we facing a recession and should they be buying bonds? The 10-year Treasury is also a bond that investors tend to buy. And if you check that out, it's been kind of all over the place because investors just simply don't know where the economy is headed. You may or may not know it, but BiggerPockets has a list of mortgage brokers who are investor friendly. You can check that out for free at BiggerPockets.com/find a lender. And I cannot emphasize enough the importance of working with a lender who understands investments. Is very, very different than buying your primary residence. So what does this have to do with you? Well, first of all, if you're really waiting for mortgage rates to come down, you're going to have to see a problem. You're going to have to see something recessionary. And you would probably see that if we start to see more jobless claims or if we start to see the unemployment rate go up. Right now, we still have over 8 million job openings. So we don't see that anytime soon. Also, we would need to see inflation get down to 2% for the Fed to stop hiking rates. And we're not there yet either. The last inflation reports came in not so great. There's still inflation out there, which again has investors going,
wait a minute. In December, the Fed said they were going to cut rates, which means there might be
So again, investors kind of don't know what to do, and neither does the Fed. But what does this mean for you, and what should you do? Well, let me tell you at least how I see it and what we've been doing at Real Wealth. I tend to be more of a contrarian. I don't want to follow the masses. For example, in 2021 and a few years before it, there were so many people chasing properties that there was just, as you know, multiple offers, prices going up, sometimes 100 people bidding on one property. I don't like to play in that ball game. That's just too much competition, and I would prefer to get a really good deal. Of course, unless you're buying a primary residence that you're going to live in, who cares? It doesn't matter. You need a home. You're willing to pay whatever the payment is that you could afford to have that home, especially if you're going to live in it long term and it's a fixed rate. That's different. I'm talking about investing. I don't want to go up against 100 other investors and bid a property up above what I would normally pay for that property. So we kind of sat on the sidelines for sure with multifamily. We saw that just going way out of hand with prices going too high from so many multiple offers. However, as soon as the Fed said that they were going to raise rates, which meant that they're going to slow down the economy, and we saw also mortgage rates rise at the same time, this told me this is my opportunity. This means that the competition is finally going to be gone. So instead of doing what the masses were doing, which is to panic and not buy anything for fear that rates would go up and the housing market would crash, we dove in. And we, over the last year, bought over 50 properties. In fact, I think close to 60 now. I started a single family rental fund, and we went out and started buying properties in North Texas that had some kind of issue with them. But with a fund, we were able to raise cash and pay all cash for the property, so we didn't have to worry so much about the rates. And so many other people were priced out because flippers, they couldn't make the numbers work with the higher rates. There were millions of home buyers that could no longer afford to buy. So that left us. It's not so much the rates that matter as the deal and the competition and the opportunity. That's where the focus should be. Now, right now, we don't know if rates are going to actually go down because the economy is still acting really hot. Now, a lot of people are kind of wondering why. My personal opinion about that is that over $7 trillion was created over about an 18-month period during COVID to stimulate the economy. And they may have just obviously overdone it. $7 trillion was the amount of money in circulation in entirety in 2007. If you can imagine that, the entire US economy in 2007, all of that money was created during 2020 to 2021. So it's like we threw in a whole economy into our economy, and that money didn't just disappear. That money is still circulating. There's a lot of people sitting on cash. There's a lot of people who bought things with all cash. So it hasn't left the market yet. And that's what the Fed is trying to do. They're trying to still get that money out of the market to slow things down. And they haven't been totally successful at that yet. I don't know why they're so surprised. It seems kind of obvious to me. But with this in mind, it may be a while before we start to see those jobless claims. It might be a little bit more time before we see real serious unemployment numbers because, like I said, there's over 8 million job openings right now. The other thing to keep in mind is whether or not whatever you're trying to invest in is in demand. And what we know right now is that housing is in great demand. The millennial generation is the largest right now. And the largest part of the millennial generation is at first-time homebuyer age. They're just starting families. They have pets. They're settling down. And most people starting families don't want to live with mom and dad. They want to have their own home. So with so much demand and yet so little inventory because over the past decade, builders have not been as active as they have been in the past. New builds have not kept up with demand. On top of that, we have millions of people who did take advantage of those 2%, 3% mortgage rates and are sitting very comfortably in their homes with super low mortgage payments. There is very little distress in the housing market. And when there's not a lot of distress, you're probably not going to see a housing crash. You wouldn't sell your house for a massive discount if you don't have to. In fact, you really aren't going to sell your house if your house payment is much lower than the rent you would pay for the same house. So that's where we are today. People staying put. They're in a very good position, super low home payments compared to their wages, which have generally gone up over the last few years. And there's just not the distress there that there was, say, in 2008. The difference also is that many people are in fixed rate mortgages versus adjustable rate mortgages. Back in 2008, most people were in adjustable because it was cheaper, because it was easy to get. And people just wanted to save money by not getting the 30-year fixed rate. That is totally different today, where over the past decade, people got into a 30-year fixed rate mortgage and are sitting on a fixed payment all the while rents are going up. They're not likely going to be interested in giving up their low payment just for higher rent. So again, what does this mean for you? It means that there's probably no housing crash in sight. There might be a recession coming, but probably not this year. And if you're trying to build wealth in real estate, you just have to be able to find a good enough deal that makes sense with today's mortgage rates because they may stay here for a while. And the good news is that when rates go up, prices can come down in some markets. And in other markets, like where we bought in North Texas, we're seeing such massive growth that actually we're seeing more cash flow, higher cash flow than we've seen in the last few years. We also bought some new homes because distress today is with new home builders who were very much affected by higher rates. And so we've been able to negotiate with them to not only pay points to make our mortgage rate lower, but also to lower the price of the home. And also insurance is a lot lower on new homes as well. And that's been a problem the last few years. So it's always important to be pre-qualified with a lender so that if you do find that deal, you're ready to go. So the most important thing is knowing what your buy box is, what are you trying to find? And the more clear you are about that, the more you'll be able to spot it when it's out there. That's exactly what we've been able to do. And it has been a really successful year with us at Real Wealth in our personal portfolio. Now, the downside of waiting for rates to come down are, number one, prices on real estate have been going up, even with higher rates. And that's because there's simply not enough housing for demand. So the longer you wait, the more expensive it might be. If rates do come down, well, then now people will come flocking back into the market and you'll have all that competition, which could drive prices up again. So waiting, you might, again, pay more. And when there's more competition, then you have to make crazy offers like fewer days for contingencies or inspections. I know in the San Francisco Bay Area, my niece is a real estate agent, and people were just bypassing the inspection altogether. It was like, hey, we just want to get this property. We want to have the winning bid, and we're not even going to do an inspection or have any contingencies. So that's not great. I highly recommend that you not be pressured and that you're able to get your inspections and have contingencies. Contingencies meaning that if you do the inspection and you don't like what you see and there's all kinds of problems with the house, you can get out of the contract and get your deposit back. And this kind of thing, is harder to do and harder to negotiate when there's more competition. So the longer you wait, and especially if you wait for rates to come down, the more likely you are to be in a bidding war like we were over the past few years, in 2020 and 2021. So if you got anything from this video, I hope it's that don't worry about interest rates. Right now is still a great time to buy real estate. As I said earlier, we've been very active. In our fund, we bought over 50 houses this past year. The prices have been lower than we expected, and the renovation costs have actually been lower than expected too because prices have come down on material costs and labor. Thank you so much for your time. I'm Kathy Fettke, co-founder of Real Wealth and co-host of BiggerPockets on the Market podcast. If you found this video helpful, please subscribe to BiggerPockets so that you'll be alerted when the next video comes out.